Thank you, Darby. Good afternoon, everyone, and thank you for taking time this afternoon to just dial in and listen to what hopefully is a short update on income provider. I think obviously we all experienced an unprecedented March. We're all uncertain with regards to what's happening globally, locally with the lockdown. It's putting stress on all of us, all trying to figure out working from home and all this. So I appreciate that you're taking the time, and we just really want to take you through some of our thinkings, some of the ideas, touch on what happened to the fund in March, and then most importantly, the outlook going forward. Very important is the income or the fund yield hasn't really been impacted. We expect the distribution to be the same more or less as the previous couple of months. And that's very important to understand. So if nothing happens in the fund in terms of asset prices, you expect to earn 8.25 for the next year. So just maybe then on the what was the drivers behind the mark-to-market negative return in the fund for March. Really it was 4 components, and I'll just go through each one of them separately. The first one was the offshore piece. So 12.2% in the offshore. The way we do that is by buying South African names offshore, so top 4 banks and the government. The dollar bonds they issue. What we saw as emerging markets and global asset prices got sold off, these bonds in the offshore market also moved. If you look at the South African credit space, in the South African context, the yields or the spreads didn't move, but in the offshore market they did. And really the biggest driver of the negative return during March was the spreads in those offshore bonds moving higher, and the fund saw mark-to-market negatives on those. So if you look at the underlying assets being the top 4 banks and the SA government, we really don't think that there's any default risk there. In fact, we think there's a great opportunity to be buying some more in the offshore market. We've been hesitant to be too active in the current market environment. We do see the market as fairly dysfunctional at this point in time. The illiquidity that we've seen has seen bid-offer spreads and pricing in the market not be efficient, and in those kind of market conditions, it's prudent not to act. You don't want to be a price taker in those kind of markets. So we'll wait for some normality, and we have seen an improvement over the last couple of days. But we will wait to see a bit more before we look to increase that offshore exposure. If you're buying, as an example, 3 to 4 year South African debt in the offshore market, you hedge out all the currency risk. So all the offshore, the 12.2% is all hedged, so no dollar exposure. If you hedge it back into rands, you're earning between 10 and 12% for South African risk for the next 3 years, which I think is a fantastic yield. I think the risk in most of these things is going to cash at 4, 5, 6% at this point in time, and not taking the opportunity in the great yields we are seeing in the South African offshore fixed income market. So that's on the offshore side. The second building block that saw some negative returns during March was the preference shares. So at the moment, 2.5%. Those are the top 4 bank prefs, and really, very, very unexpectedly sold off aggressively during March. So down 25 to 30%. So earning 12 to 14% on top 4 bank prefs for us is a great opportunity. We think it's a great asset class for the income fund. We haven't sold down any exposure, and we expect that to come back in the not too distant future. We've had some questions around risk of dividends not being paid on the preference shares, and really what we see there's 2 reasons that could happen. One could be from a regulatory perspective, and the second one from a profitability perspective. And if one looks at both of those, the first one, the 4 banks' capital ratios are still very much intact, north of 11%. And to trigger non-payment of dividends, you need to be closer to 7.5%. And that really translates into about 100 billion per bank that needs to be further written down before preference share dividends becomes a problem. So we're comfortable with that part. And then on the profitability side, yes, there will be constraints, but if you look at the the way dividends are paid, the ordinary dividends could potentially be slashed to zero without the bank touching the preference share dividends, and that really speaks to preference shares dividend being part of the profit and loss of the bank, where ordinary dividends are part of the distributable income. So we extremely bullish on prefs, and where we have capacity, and as I said, if the market returns to normal, that's an asset class we would look to exploit further. Then the third building block that saw negative returns for March for us was the property, the small exposure to listed property. Very uncertain times for that sector, down 50% year to date. If you look at the underlying counters we hold, we're still very constructive on those. We think that the illiquidity in that market and a lot of selling pressure in that market drove prices to levels where they should not have gotten to. As an example, if you look at one of the counterparties, we do own a business called Tower Property Fund. At that current share price, their market cap is around 680 million. One of their buildings, they own 43 buildings across the globe. South Africa and Croatia focused mainly, but across the globe, 43 buildings. The one building was valued by Investec at 790 million not too long ago, at a stress valuation. So effectively what we can do there is buy the entire business for less than the price of one building. That just gives us a good sense of how the pricing in the market, because of this illiquidity and search for liquidity, has gotten to, and we are very comfortable still that the counterparties we own are good counterparties. Yes, there's some uncertainty around tenants, etc., with force majeure close downs of shopping centers, etc. But our exposure to retail is fairly limited, and we do think that the 20, 30, 40% dividend yields we're seeing now, even if they're halved, are still fantastic value. If you look at the long run for income fund, the income provider, real focus of the fund is to beat inflation by 3 to 4%. And if you think about property or building costs goes up with inflation, then really whatever they pay out on top of that is inflation plus. So, the long run, a great asset class for income funds. Our exposure was small, but even that small exposure saw negative returns for the month, which is unfortunate. And then the final building block that hurt the fund during March is, if you look at the top of the pie chart, is the fixed bonds. And really what we did there is to increase our duration in the fund. So that's our interest rate risk in the fund by about 0.3 of the year during March. As we saw yields sell off, we started to see a lot of value, and we wanted to capture some of that, and we increased the duration of the fund slightly. But subsequent to us increasing duration, the yields kept going higher to levels we've never seen. I mean, at some point you were earning 12.5%, 13% for a 5-year government bond. That's the most liquid traded instrument in the market. So extreme value. We still think there's extreme value there at the moment at 10.5% for 5 years. We think it's, again, as I said earlier, the real risk here is by, selling out of these assets, locking in losses, and then going to cash. Our view on cash is that potentially the MPC cuts rates by another percent. If you look at what the market pricing, sort of around 60, 70, 80 basis points, we do think that, after them cutting a percent at the previous meeting, it would be foolish not to follow that up by another percent. If you consider what's happening to global rates and global central banks trying to prop up economies worldwide. So we do expect them to cut rates again, taking cash to 4.5%, 5%. And I think if you're selling out of these high yielding instruments at this point in time, and that really is where the risk lies. So those really are the 4 building blocks in the fund that caused the fund to have a negative return for March. As I said, unexpected completely. Would never have expected all 4 of them to do what they did. But as I said, as we go and dive deeper into each one of those and we look at them, there's no real risk for us that there's default there. We don't think that these market prices down are there to stay. We do think it comes back. As I said, very importantly, the income yield in the fund hasn't dropped. With the asset allocation ability of the fund moving away from JIBAR assets, the fund yield is still sufficiently high to get to our target of 3 to 4% over inflation. I put up this table for us just to look at the exact numbers. So these contributed to the return for the month And you can see, the offshore being the biggest piece, and then really the duration, which then I spoke to, the interest rate risk and the property, all contributing to the negative 2.79% for the year, or for March, and just below 2% for the year. It's not great to show negative returns in the income fund, but it's important to understand that income funds aren't money market funds. There is some asset allocation that happens there, and considering the size of the sell-off, I think our conservative nature, or at least the defensive nature of the portfolio going into it, stood it in good stead. And as I said, going into each drawdown, we don't think those are permanent, and we expect those to come back in the not too distant future. So what we're looking at here, and what I wanted to show you, is the income yield in the fund. So we're looking at the next 2 years, so that's the average term of the assets in the fund. So if we hold the fund to maturity, we expect the fund to earn income yield that's currently in the fund, and then make an assumption to say, okay, let's cut rates by 1%. What's the margin that we'll earn above money market for the next 2 years? And really what we're trying to illustrate is that, yes, we've seen mark-to-market volatility on the asset price, or on the capital side, but the income generated and the yields in the fund hasn't been impacted as much, and we do think that it's still earn in inflation 3 to 4 over the next 1 year. And then finally, I just wanted to touch on a further risk in the market that we're seeing at this point in time. It didn't really materialize yet. It's really because of liquidity, but that's looking at the credit market in South Africa specifically. During March, that dried up completely. There was almost no liquidity in that market. And now what we've started to see last couple of days of March, and really first 2 days of April, is a lot of selling of credit, and spreads are starting to move higher. And this is important for us to highlight, because we see real risk in the credit market at this point in time. And a lot of these prices haven't been reflected yet in some of the funds, and it's important to understand that it's not only your duration or your interest rate risk that's important in an income fund, it's also what we call your term risk that's important, and that really speaks to this credit piece. So maybe just to chat through each one of these. Credit quality, what we mean by that is what's the quality of the counterparty that we're lending our money to, and really what we're speaking to here is default risk. We don't think that the income provider has any default risk at this point in time. We focus on high quality counterparties. We have been for a while. And those of you that seen me in the last year and a half would know I sound like a broken record here, but we've been very negative to the credit market for a while. And really our focus is on the top 4 banks in South Africa. And the addition of duration via the government bonds, so top 4 banks and government exposure. And we do think that's high quality counterparties. So from a default risk, we think the fund is very well positioned. Then really the term risk, which is for us at this point in time a lot more important. And really what that means is well, how long is the portfolio exposed to the price that they were paying for the credit they were buying? So if you're buying very expensive credit where the market was, and you've locked that in for 5 years, the longer that term, the higher the loss the fund will take if spreads do start to move. And we've managed down the average term of our credit assets to below 1.5 years, so 1.44 years to be exact. And that really means that if spreads do continue to widen, which we do think will happen, the fund will be well protected from this spread widening. So if a fund had a 5-year term and spreads move 1%, the fund will be down 5%, as an example. Then finally, what's really important for us at this point in time as well, and I think that's what's going to drive spreads going wider, is the liquidity in this market. You do find more liquidity in higher quality names with shorter terms. The lower the quality, the longer the term, the less the liquidity. We do think going into the next couple of months, having liquidity in a fund is very important. And we've had a lot of focus in trying to generate that. Again, speaking to the defensive nature of the portfolio. So really, I think it's important to understand that we do expect some pricing pressures to come through on the credit side, it's important to ask the question around funds, what's the average term of the fund, regardless of the interest rate risk or duration. You need to understand the term risk in the fund to understand how it will be impacted by the spreads or the price of credit moving, as we've seen in the last couple of days. And that really is all from my side. I'm happy to field questions if there's any.
Thanks a lot, Henk. So I've gotten quite a few questions directly posted to me. I'll open the chat function to everyone now. You can post questions there. Henk should be able to see it, although yesterday he did struggle a little bit. I'm
not going to be able to, Darby, I can't see it if I'm sharing my screen, so you'll have to read the questions to me.
Okay, perfect. I'll just read them out. So let's start off with Mark Thomas. Mark, I think the question was answered, but to what extent will lower interest rates affect the forward yield of 8.25? What can we expect going forward? So I think that one slide of yours did cover that, Henk. I don't know if you want to put another answer there.
Yeah, so just to give you exact numbers on the fund and the sensitivity of the fund to interest rates being reduced. The beauty of being able to asset allocate into the income space is you get to diversify away from JIBAR risk or interest rate risk really in the fund. So if we stress the fund for % lower, so let's assume they cut another %, so JIBAR goes down by 1%, the fund yield drops from about 8.25 currently to about 7.56. So it's not, you don't see the full % priced in, where if you look at money market and cash, you get the full 1% priced into the yield. So that really speaks to the offshore component, the property, the prefs, that's not affected by interest rates being reduced.
Okay, and then a follow-up from Mark. He said, how can you earn 8.25 when 28% of the portfolio is in floating rate notes?
So if you do the breakdown of the different asset classes and you look at the yields that we're earning on, for instance, the fixed rate bonds at 10-11%, the property dividend yields of between 20 and 40%, the prefs at 12 to 14%, the offshore component at 12%. If you add all of those up, then in conjunction with the money market, the fund yield gets to about 8.25. So it's the ability of the fund to do asset allocation to the different sources of income that gives us the ability to generate that yield.
Okay, perfect. There's quite a lot of questions coming through. We are not going to get to all of them. I think I'm going to pick out a couple of important ones here. There's questions with regards to bonds. So James and Jack Probart, will we extend duration with long bonds at 12%? And I think Jack's question is similar. Are you buying more government bonds?
The answer is we should be, but we have very strict capital preservation controls in the fund. So at this point in time, we would wait for the market to normalize somewhat before increasing that risk. But if you think 5-year government bonds at 10-11, one should be buying that. The risk, as I said, is missing out on those great fixed rates. If let's assume inflation goes to 5, that's inflation plus 5.5 for the next 5 years. I think that's a fantastic asset to hold. So in short, we haven't increased since we've increased in March, but you can look for us to do that the moment we see some normality in the market return.
Okay, and then what level of government bonds do we hold versus corporates? So what percentage versus corporate?
So the government bond percentage, the fixed rate bonds we own is around 6%. And then if you add the government inflation-linked bonds, that's another 4%, so about 10%. Then SOEs are probably about another 10%. Those are government guaranteed, so effectively 20%. Then about 60%, I would say, is top four banks, and then the remaining will be corporate. So not a big corporate exposure in the portfolio. As I said earlier, we are trying to focus on high quality issuers and where we see there's more liquidity and where you'll be protected from spread risk.
Okay, then two from Stephen LaRue with regards to credit. Some funds claim that they are negatively impacted since they hold liquid instruments and are marked down day to day, where other funds still hold illiquid instrument that has not been marked to market. Is this true, and what's your view?
That is true. That's a very good observation to make. So for the price of the credit to move, the instrument needs to trade. If you look at the income provider fund, most of the instruments we hold have been trading. Some of the credit-linked notes have not. But if you have a portfolio full of worse quality illiquid credits that hasn't traded yet, the risk there is that when they do start to trade and liquidity is needed, that there is some aftermarket price impacts that will be coming to some of those funds. I can't really speak to which funds and peers, but that's definitely a true observation that the more liquid the instruments, those funds have seen prices move, and the illiquid instruments we haven't seen the prices marked yet.
I think that's something we've been quite vocal about, and a big risk in the income space that is not really reflected in the performance numbers year to date or for the March or months to date. Then from Willem de Vos, how likely or unlikely is it that the SA banking system will not survive the defaults that is now about to rise from already stretched businesses and personal lenders?
Yeah, we do a lot of work around the banks, and I think it's a very important question to ask at this point in time, is that we need to make sure that our banks are healthy, and we are in constant discussions with the top 4 banks, and they are in constant discussions with the Reserve Bank, and we don't foresee the Reserve Bank letting any of the top 4 banks go under. They are very much on top of any stresses that we've seen. If you think back 2 weeks ago in the money market space, a lot of liquidity was created there with banks getting back their paper. And we saw a little bit of stress in terms of the pricing, and the SARB just stepped in and created liquidity, gave regulatory relief for the banks, and made sure that market returned to normal. So we are still very comfortable with the top 4 banks. If you look at their capital stack, yes, it's been impacted, but it's still a long way away from seeing any sort of defaults or cutting of dividends or coupons on sub-debt being triggered. So we are still very comfortable with the top 4 banks. Yes, from an earnings perspective and a shareholder perspective, I think there's some risk there. But as a debt holder, I do think that the top 4 banks are still very well capitalized, and we are still comfortable to hold that, that exposure. So good question, something we must definitely watch out for. But as I said, I don't think the SARB lets any of those top 4 banks go under. And from our assessment and our discussions with them the last 2-3 weeks, and we are very comfortable that they're still very well capitalized and healthy, even with the expected losses that's coming due to the very restrained economic environment over the next sort of 6 months, I guess.
Then James, I think that more or less answers your question. He asked if yields on the bank paper is protected if the banks are told to withhold dividends.
Yes, so I think the yields on the banks will be more protected. They haven't been. So, they will also move wider. If you look at some of the senior bank bonds, that's because there's liquidity there, they've traded and they're trading wider. So those credit spreads have moved. If you think that Moody's downgraded the sovereign, then they automatically get, they have to downgrade the banks. The banks can't be higher than the sovereign. You should expect spreads for the banks to also widen because of the, more restrained environment which they have to operate in. But I think from a spread perspective, the banks are more protected than corporates, and there's also more liquidity there. So I do think that their funding does go higher. but not to the same extent that some of the corporate credits out there will.
Okay, and then Neil Lucas asked why the offshore performance has been so negative considering the weakness of the rand.
So the offshore piece is all hedged back into rand, so we don't try and take views on the currency. We have a strict capital preservation mindset. So if you think about not losing capital over rolling periods, you don't want any negative currency exposure. And really what we do on the offshore side is to focus on SA names we're comfortable with, and then getting the yield pickup that we do by bringing back the currency. So the offshore piece was all hedged back into rand, so there was no currency valuation there. It really was the spreads of the offshore bonds that we hold that moved higher, that saw the mark-to-market loss in that piece. So again, I think it's fantastic yields, a great opportunity there. It's unfortunately, absolutely, but we do think that comes back in the not too distant future.
And then from Paul Cantor, any guesses on currency level post downgrade? We must be oversold.
Yeah, it's a very good question, and I wish I had a crystal ball. But if we look at all valuation metrics, the rand is definitely oversold. But if you look at what is transpiring globally and what really is going to be needed to be done in South Africa, in terms of bailing out, the markets from buying bonds from the SARB, etc. All that comes down to is really printing money, and we do think. And it's our view that if we continue down this path, and we should, by buying bonds and doing QE, etc., and creating liquidity in the market, the rand will continue to weaken. So I'm very reluctantly want to say that we do think it weakens further, but at what level that stops is a very good question. But you're absolutely correct. I think we're very oversold. The rand looks very cheap. I think there's a reason for it, and I do think that there's potentially some more weakness to come if the SARB continues to print cash and assist the markets.
And then there's a question with regards to liquidity of income provider. How quickly can the fund be liquidated? We did a full liquidity analysis on the fund end of last year. We can share that with anyone who wants it, but maybe you can just touch on that.
Yeah, so I'd up liquidity profile about a week ago. Obviously, with the markets being very illiquid at this point in time, it's important to try and understand the liquidity in the fund. And what our assessment of the fund is that around 60% of the fund we can liquidate within a month. Of that, probably 30% within a day. Just given that there's not stress in the money market anymore, and the government exposure we hold is very liquid. So we do think we have a lot of liquidity in the fund, but saying that, we also don't want to be liquidating too many positions in the current environment. We think it's highly risky to be a price taker in this market, and you don't want to be locking in, these levels in the fund. So yes, the fund is very liquid. We are, in a good position to be able to accommodate withdrawals or drawdowns, but I think it's the wrong time to be doing that. So happy with the liquidity profile of the fund, but I think we need to be cognizant of the fact that the market that we're operating within is not functional, and given that liquidity needs to be well managed.
I think almost one of the last ones, as time is about to run out in 3 or 4 minutes. Corporate bonds outside the big four bank holdings, are there any issues? Are there any issues with our holdings which could come under pressure going forward, default risk?
So our assessment of the holdings we have is no, we don't foresee any default risk. Obviously we monitor those closely. We have a credit team that does that for us on a daily basis, and given where the market is and global economies are, I think it's very important to have a very, very good handle there. The counterparties we do hold, a few, we don't foresee any default risk. So we think the fund is well protected from that perspective. but it's very, very, very important to keep monitoring that on a daily basis. I mean, if we were taught anything over the last 3 months, is to not assume you know anything, and just to make sure that you stick to your process, double check, recheck, and then double check again, and make sure that you don't get hit from the side by something that you didn't see coming. So we're happy with the credit exposures. We don't see any defaults, but I can give you my certain that we definitely focus and monitor that every day.
Yeah, I mean, we're very happy to share the holdings. Just ask your relevant consultants and we'll share that with you guys. And if you've got concerns on any names, then we're happy to answer that.
Yes, good question. So we don't have any Edcon exposure. We don't have Edcon exposure. We don't have any Sasol exposure. Those are some of the names that for us comes across a bit risky. But as Darby said, happy to share the portfolio with you guys. Darby, I see there's a question from JD on debt in the Tower Property Fund. So loan to value ratios are still well contained, so we don't think they over leveraged. And what's very interesting and what we'll look out for in the next sort of couple of days, and I think important for all of us to look out for this, is in the property space. Obviously, the REITs have to pay out a high percentage of income, and we expect that, or we foresee that they could relax that and cut some of that payout to try and help these funds to create some liquidity. We think that will be very bullish for these stocks. So, I mean, we're not concerned about the debt in the Tower Fund. We think they still, they were conservative in terms of gearing, and they should be able to navigate the next while.
I think that is about it. Our time is going to run out very soon. Maybe one more from Mark, and if the meeting just finishes, thanks for everyone's time. Anything we didn't get to, please ask the consultants. We will get back to you via email, and I'll also share this recording with everyone. Thanks a lot, Henk. The last question, I think, is inflation expectations.
Good question. So I think in the shorter term, we should expect inflation to move a bit lower, so be lower than what currently is forecast. Obviously, given the uncertain nature of the impact on the global economy, it's difficult to make any sort of assumptions, but I think we should expect inflation to be lower in the sort of shorter term. But given all the cash that's going to be needed to be printed and that's already been printed globally, I do expect inflation to start moving higher in the medium term. So I don't think it runs away, but I